Good morning and welcome to the Deep Dive Bulls, Bears, and the Bell morning edition. It's Friday, September 19th, 2025, and yeah, we've got a big mission today. We're doing a deep dive into this morning's pre-market intelligence, really trying to cut through some of the noise because, well, the market seems poised for a pretty volatile session. I mean, yesterday we had that huge record-setting rally, right, fueled by the Fed's rate cut, but today, that euphoria seems to be hitting some serious headwinds. We really need to help you figure out what's signal and what's just noise.
Absolutely. That tension is, you can almost feel it this morning. Looking across the reports, there are basically three major forces colliding right now. First, you've got this big divergence in central bank policy. The Fed's easing, but Japan, they're starting to tighten. Second, there's the, let's call it the post-Fed reassessment. The market's, finally digging into what Powell actually said. And third, looming over everything is the sheer mechanical volatility from today's quadruple witching. It's kind of a perfect storm setup.
And you see that conflict playing out right there in the futures, don't you? U.S. equity futures are ticking slightly lower. S&P 500 down, what, about 0.18%? Like someone hit the pause button globally. But here's the really interesting bit, the thing that sort of stands out. Despite all these, high-impact risks we just laid out, the VIX, the SIBO Volatility Index, still pretty calm, right? Below 15, what does that tell us? Complacency, maybe?
That low reading is definitely a bit of a head-scratcher. It could suggest complacency. The VIX is supposed to be the fear gauge, after all. So below 15 could mean traders feel they're well hedged, maybe through options or other derivatives,
Or they're just not paying attention.
or they're perhaps underestimating the combined punch of these macro events and the afternoon's mechanical volatility. Given everything lining up today, that subdued VIX.
Well, it feels like a warning sign that maybe folks aren't quite ready for potential swings. Okay, let's dig into that first big force then, the central bank policy tug-of-war, starting with the Fed. Yesterday, they did what the market seemed to want. First rate cut of the year, 25 basis points, took the Fed funds rate down to that 4.00% to 4.25% range. Boom, S&P 500, Dow, NASDAQ comp, all new all-time highs.
Right. The initial pop was definitely relief. They finally did it. But then, like you said, people started reading the fine print. Chairman Powell was very careful with his words. He called the cut a risk management adjustment, not, the start of some big easing cycle.
Subtle but important distinction. Risk management implies fixing a specific problem, not necessarily a broad policy shift yet.
Exactly. It tempers expectations for really aggressive follow-through. And then you layer on the dot plot.
Right, the chart showing where Fed officials think rates are headed. Always causes a stir. What did he show this time?
Well, it definitely wasn't dovish. It basically signaled maybe only 2 more cuts this year, 2025, and just 1 penciled in for 2026. That limited outlook really poured cold water on the initial rally, and you saw it immediately in the U.S. dollar index. It snapped back pretty hard from those 2022 lows it was testing.
So the message is, the Fed cut, but reluctantly. Still worried about inflation sticking around.
That seems to be how the bond market is reading it. They're easing, yes, but maybe with one foot still hovering over the brake, very concerned about inflation becoming entrenched.
Okay, now let's contrast that cautious move with what's happening over at the Bank of Japan, the BOJ, because that's a completely different story, isn't it?
Night and day, really. While the Fed is sort of reluctantly tapping the brakes on tightening by easing slightly, the BOJ is signaling a move towards actual normalization, tightening. They announced this frankly, landmark policy shift. They're going to start selling off their massive holdings of ETFs, exchange-traded funds, and J. Wright's Japanese real estate investment trusts.
Whoa, okay. Selling assets. That's quantitative tightening, essentially, even if they say it's gradual.
It's what some are calling the normalization shock. Now, you're right. They're trying to manage expectations. They say the pace will be extremely gradual.
Yeah.
So gradual, some estimates suggest it could take over a century to fully unwind the whole portfolio.
A century? Okay, that sounds symbolic, like they're trying not to spook the market. But the market did react immediately, right? Nikkei down, yen stronger.
Exactly, because the pace isn't the main point right now. The signal is crystal clear. The era of ultra-cheap money from Japan, the bedrock of so many global trades, is starting to end.
And that hits the carry trade. Explain that again quickly. Why is the carry trade so sensitive to this?
Sure. The carry trade in its simplest form is borrowing money where it's super cheap, like the Japanese yen has been for ages, and then investing that money where you can get a higher return, often in US dollars or other currencies. But it relies on the yen staying weak or stable the moment the yen starts strengthening, like it did on this news. Is right. Traders who borrowed yen suddenly find their loans getting more expensive in their home currency terms. To close the trade, they have to sell whatever assets they bought globally, U.S. stocks, bonds, whatever, and buy back those yen to repay the loan.
So BOJ tightening, even just signaling it, forces selling pressure, potentially everywhere, not just in Japan.
Precisely. It could trigger broad-based selling across international markets as those carry trades unwind. That's the big global risk today, this policy divergence forcing capital to reshuffle, regardless of how slowly the BOJ says they'll actually sell.
Okay, that sets the macro stage. Now layer on top of that this quadruple witching thing. Sounds pretty ominous. What does it actually mean for trading today?
Yeah, the name's a bit dramatic, isn't it? But it's just a calendar event, happens 4 times a year. It's when 4 different types of derivative contracts all expire on the same day. We're talking stock index futures, stock index options, individual stock options, and those single stock futures.
So basically, a ton of contracts are coming due today,
Hmm.
and big players have to deal with them.
Exactly. Huge institutions, pension funds, hedge funds, investment banks hold massive positions in these derivatives. Expiration means they have to act. They either need to close out the position, letting the contract expire, or roll it over into a new contract for the next quarter.
And that forced action creates volatility.
Both. Big time. We often see trading volumes spike dramatically on these days. Think like going from an average of maybe 7.5 billion shares traded to well over 10 billion, maybe even 10.8 billion based on past events. And importantly, a lot of this volume isn't driven by some new economic insight or company news. It's purely mechanical flow related to these expiring contracts.
And there's a specific time to watch, isn't there? The witching hour.
That's right. Usually the most intense activity gets concentrated into the final hour of trading, from 3:00 p.m. to 4:00 p.m. Eastern Time. That's when positions are finalized, settled. It can lead to really unpredictable, sharp price swings.
So you've got this fundamental repositioning happening because of the Fed and the BOJ news.
Right. Institutions might want to shift their portfolios anyway because of the changing central bank outlook.
And then the quad witching comes along and basically forces a whole bunch of trading activity, especially in that last hour, amplifying whatever moves are already happening.
That's the potential danger. It's like pouring gasoline on an existing fire. The macro shifts create the underlying pressure to reposition, and the mechanical expiry forces the trades to happen, potentially all at once, amplifying the moves. It's why everyone's saying risk management is key today.
Makes sense. So given that volatility seems almost guaranteed this afternoon, where might we see the most pressure? Let's look at some specific stocks and sectors. The semiconductor space had huge news. NVIDIA investing a whopping $5 billion into rival Intel for next-gen chips. Intel went absolutely ballistic yesterday, up nearly 23%.
Yeah, that was seismic news for the sector, and it's much more than just a short-term pop for Intel's stock price. Think about it. NVIDIA, the undisputed leader in AI chips right now, putting $5 billion into Intel. That's a massive vote of confidence in Intel's turnaround plan, especially their manufacturing ambition.
Like NVIDIA saying, okay, we actually believe Intel can pull this off.
Pretty much, and it signals this interesting dynamic, this co-opetition, as some are calling it.
Co-opetition, cooperating and competing. Why now? Why this specific Team USA angle people are talking about?
Well, developing these next-generation AI chips is incredibly complex and, frankly, astronomically expensive, even for giants like NVIDIA and Intel. By pooling resources on certain aspects, they can potentially speed up development, share the immense R&D burden, and, crucially, strengthen the U.S. domestic semiconductor ecosystem against fierce international competition, particularly from foundries in Taiwan and South Korea. It's strategic.
But even with that huge strategic rationale, we're seeing some profit-taking this morning. Both NVIDIA and Intel are indicated down a bit pre-market. NVDA off like 2.6%, INTC maybe 2.15%.
Totally expected, especially ahead of a quad witching day. People locking in those massive gains from yesterday makes perfect sense. The real question now for you as an investor watching this is whether this pullback is just a healthy consolidation before they establish a new, higher trading range based on this partnership, or if maybe the initial euphoria wears off a bit.
Okay, what else is moving pre-market that tells us something bigger?
Well, you absolutely have to look at Novo Nordisk NVO. It's up, 7.6% pre-market? Huge move.
On their oral obesity pill trial results.
Yes, positive late-stage results. This just reinforces that massive ongoing theme in the pharma space around weight loss drugs. It's clearly a trend with staying power.
And on the flip side, any notable losers?
Let's see. Moderna, mRNA. Looks like it's down pretty sharply, over 7%. Not immediately clear what the catalyst is there. Need to watch that one. Also, Nucor, the steel company, and UE, they cut their profit guidance, and the stock's reacting as you'd expect, down about 3.75%. Signals some caution maybe creeping into the industrial outlook.
What about earnings after the bell yesterday?
Got a few.
FedEx, Lennar.
FedEx FTX was pretty muted, actually, up just at a tiny bit, maybe 0.2% or 0.3%. So no big surprises there, it seems. Lennar, LN, the home builder, though, that was interesting, up about 0.5%, which doesn't sound like much.
But expectations were super low, right? Like forecasting a massive earnings drop.
Exactly. Consensus was calling for something like a 45% decline in earnings. So for the stock to react positively, even slightly, suggests the results must have significantly beaten those very low expectations.
And that optimism ties back to interest rates. Hope for lower mortgage rates helping housing.
Absolutely. Even the Fed's reluctant rate cut provides a glimmer of hope for lower borrowing costs. The 30-year fixed mortgage rate has ticked down a bit, hovering around, say, 6.1% to 6.35%. Homebuilders are incredibly sensitive to mortgage rates, so any sign that rates might be stabilizing or heading lower can outweigh even mediocre earnings news. It shows how powerful that rate narrative is for certain sectors.
Okay, let's tie this all together. Let's look across asset classes, starting with the bond market. You mentioned it earlier, the Treasury market seems to be sending a conflicting signal.
It really is the key contradiction today. Normally, Fed cuts rates, bond yields go down. Simple enough playbook. But look at the 10-year Treasury yield. It actually ticked up slightly, hovering around 4.13%.
So the bond market, which is often seen as the smart money, is basically saying, nice try, Fed, but we're not buying the easing story just yet.
That's one interpretation, yeah. It suggests the bond market is weighing Powell's cautious risk management language and that hawkish dot plot much more heavily than the actual 25 basis point cut. They seem more focused on the risk of sticky inflation persisting, which would limit the Fed's ability or willingness to cut much further.
And if long-term yields like the 10-year stay elevated or even rise, that acts as a brake on the economy, right?
Yeah,
Especially for rate-sensitive parts.
definitely. Higher long-term borrowing costs counteract some of the stimulus from a lower short-term Fed funds rate. It's a headwind for sectors like tech, real estate, even potentially impacts the positive sentiment we just saw with Lennar if mortgage rates don't follow the Fed funds rate down significantly.
And this ties into currencies and commodities, too. That stronger U.S. dollar, the DXY holding around 97.4, that's a ripple effect.
Absolutely. A stronger dollar makes dollar-priced commodities more expensive for buyers using other currencies. So you see gold pulling back from that incredible all-time high near $3,704. It's trading more like $3,650, $3,770 now. Partly profit-taking after that run, sure, but also direct pressure from the stronger dollar.
And oil, too.
Same story. Crude oil, WTI, around $63.37, is down for the third day in a row. Stronger dollar makes it pricier. Plus, those lingering demand concerns get amplified if the market thinks the Fed is only cutting rates because they see risks to growth, not because inflation is truly beaten.
Okay, so let's try and summarize this for everyone listening. It really feels like a classic market tug-of-war today. You've got the bulls, maybe cheered by the fact the Fed did cut, and look at the Russell 2000 small caps. They surged 2.5% yesterday to a new all-time high. That suggests some risk appetite is still there.
True. That small cap breakout is significant. Bulls are hanging on to that. And the hope that easing, however reluctant, will eventually boost the economy. But then you have the bears, and they've got plenty to worry about. Global tightening pressure from the BOJ potentially unwinding the carry trade, the Fed's own cautious guidance, and crucially, that rising 10-year yield screaming sticky inflation.
So the takeaway is caution, discipline.
Definitely. Today is really not the day for complacency. You have major macro policy shifts colliding with purely mechanical market structure, the quad witching, the odds of significant volatility, maybe erratic price swings, especially in that final hour. They're just very high. A disciplined, risk-aware approach seems essential.
All right, so before we wrap up, let's leave you, our listener, with a final provocative thought to mull over. We saw the U.S. dollar jump, despite the Fed cutting rates, mostly because of Powell's cautious talk and the dot plot. The bond market seems convinced inflation is still the bigger threat. So the question is, what specific evidence would you need to see in the economic data next week to confirm that the bond market's fear of sticky inflation is truly winning out over the Fed's reluctant risk management easing?
Yeah, what data points would really prove the bond market right? Maybe keep a close eye on things like housing starts, any consumer spending numbers, and definitely any more signs the labor market might not be cooling as fast as the Fed hopes. That's where you might find confirmation.
Excellent point. Food for thought indeed. Thank you for joining us for the deep dive, Bulls, Bears, and the Bell Morning Edition. We'll talk to you next time.